Good morning to all. My next topic is method of accounting of amalgamation. First, we'll see the meaning of amalgamation. Amalgamation is a form of combination when two or more existing company go into a liquidation and a new company is formed to take over their businesses is known as amalgamation. The Institute of Chartered Accountants of India has issued Accounting Standard 14 of Accounting of Amalgamation. This standard specify the procedure of accounting for amalgamation and the treatment of any resultant goodwill or reserve. So next we'll see the important terms of amalgamation. Transfer company, a company which is amalgamated into another company. The company selling its business is known as a transferee company. Transferee company, a company into which transfer company is amalgamated. The company buying other company is known as a transferee company. Purchase consideration. The purchase consideration paid by the transferee company for a purpose of amalgamation. The purchase consideration may be in the form of equity, shares, preference share, debenture, cash, etc. There is a no limit for fixing the price of transfer company. It can be at a discount, it can be at a per or a premium. Usually intrinsic value of share is taken into a consideration for a computing of a purchase consideration. Next, we see the types of amalgamation. As per accounting standard, there are two types of amalgamation in nature of merger, amalgamation in nature of purchase. First we see the amalgamation nature of merger. There are a few specific condition to satisfy that amalgamation is in nature of merger, and even few condition have to be satisfied. Even if one condition is not satisfied, then the nature of amalgamation is not treated as a purchases. Next, the condition are as follow. All the asset and liabilities of the transferor company become a asset and liability of the transferee company, means purchasing company, after amalgamation. Shareholder of a selling company holding not less than 90% of the face value of equity shares become the shareholder of a purchasing company by virtue of amalgamation. The consideration paid to equity shareholder of a selling company is in the form of equity shareholder, except in case of fractional shares in consideration is paid in cash. So next one is the business of a selling company is intended to be carried on by the purchasing company after amalgamation. Asset asset and liquidities of a selling company were taken at book value. No changes has to be made to a big book value of a selling company. Amalgamation in nature of purchase. If any one or more condition pertaining to a merger listed in above are not satisfied, then that case the nature of amalgamation that is treated as purchase. Even if one condition of a merger is not satisfied, it is amount of purchases. Next we see the method of accounting methods of accounting amalgamation. There are two method of accounting amalgamation: pooling interest method and purchase method. First we'll see the pooling interest method. Under this method, the per, under this method the asset and liabilities and all reserves of the selling company are recorded by purchasing company at their existing book value. The amount can be adjusted to follow an uninformed set of accounting policies. The reserve of the selling company are also be recorded subject to adjustment given below. The difference between purchase consideration and paid up capital of selling company is to be adjusted as follow. Exercise of a consideration paid up share capital is to be adjusted against free reserve of selling companies, secondly against the free reserve of a purchasing company, lastly debited uh, profit and loss account. Where the consideration paid up less than paid up capital, the difference is to be credited to capital reserve of purchase company after amalgamation. Next, we see the second method of accounting amalgamation, purchase method. Under this method, the asset and liability of the selling company are recorded by purchasing company in either two ways at their existing book value. The purchase consideration should be allocated to individual identifiable asset and liabilities on the basis of fair value at the date of amalgamation. Non-statutory reserve of a selling company are not be taken by purchasing company. Only statutory reserve have to be maintained by purchasing company as prescribed by the required statute. The same is not considered the purchasing consideration consumption. Journal entry will be amalgamation adjustment account debited to statutory reserve account. The difference between purchase consideration and net asset of a selling company is to be shown as follow, where the consideration paid is less than net asset, the difference is to be credited to a capital reserve of a purchasing company after amalgamation. Where the consideration paid is more than net asset, the difference is to be debited to a goodwill of a purchasing company after amalgamation. So the formula is net asset is equal to sum of asset taken over at fair value minus liability taken over at the agreed amount. This is all about amalgamation and method of accounting of amalgamation. Thank you.